During New York trading hours, roughly 8:30 a.m. to 1:15 p.m. Eastern, the action is real. After that, you'll see a bit of spillover, but activity drops off fast. By 10 p.m., we've entered the overnight session and liquidity thins out dramatically. Fewer market makers, fewer institutional desks, fewer counterparties willing to absorb heavy trades. It's like trying to sell a house at 3 a.m. Maybe you'll find a buyer, but forget about getting fair value. No competition means no price discovery. So when I watch 2,000 contracts slam the tape at 10:40 p.m., I know exactly what that is. That's not someone seeking price efficiency. That's someone trying to move the price. One contract represents 5,000 ounces. So 2,000 contracts equals 10 million ounces of paper silver dumped in one wave. And because the book is so thin at that hour, the market can't absorb it. It collapses, stops get hit, positions get liquidated. The price doesn't drift, it plunges. That's not price discovery, that's a controlled demolition. Here's where it gets strange. While New York prints $87, I'm tracking the Shanghai Futures Exchange, and over there, physical silver is moving at $159. That's not a typo, that's a $13 difference. I've been in this market for over 10 years, and I've never seen that kind of east-west divergence. On a volatile day, you might see a 50-cent spread, maybe a buck. But 13s? That's not a gap. That's a breakdown. That's a failed price discovery mechanism. Now let's break this down. In a working global market, arbitrage should close that spread fast. If silver is trading at 87 in New York and 100 in Shanghai, traders should be buying it cheap in the West, shipping it east, and locking in a $30 profit per ounce. That buying pressure should snap the prices back together within hours, maybe a day. But that's not happening. The spread is stuck. Why? Because there's no metal left to arbitrage. Western vaults are dry, or refusing to release inventory, or claiming logistical delays. Doesn't matter what the excuse is, the result is the same. That New York price means nothing if you can't get metal at that level. And that leads me to the third critical signal, backwardation. Right now, spot silver is trading 30 cents higher than the March 2026 futures contract. That might seem minor, but in commodity markets, it's massive. Let's walk through this. In normal markets, the futures curve is in contango, meaning future prices are higher than today's spot, and that's logical. Holding physical silver costs money, storage, insurance, capital, so March should be a bit higher than today. That's normal. That's contango. But when the opposite happens, when today's price is higher than future delivery, that's backwardation. And it means one thing: urgency. Buyers want the metal now. Not in March. They're willing to pay a premium just to skip the wait. They don't trust that delivery will come later. They want it in hand, today, and they're paying up for that certainty. Here's an example. Imagine a major concert, A-list artist, sold-out show happening tonight. You check resale sites and see two listings. A ticket for tonight, $500. Same artist, same venue, 1 year from now, $300. Why the price gap? Because people don't want to wait. Maybe they think this is their only chance. Maybe they don't believe the next show will happen. That $200 difference? That's backwardation. It's the market pricing in fear, scarcity, urgency, and doubt in future promises. So when I see silver trading in backwardation, when spot trades above futures, I see a breakdown of trust. Buyers are saying, forget your paper promise for March. I want real metal in hand now, and I'll pay more to get it. The fact that this hasn't reverted back to contango tells me the shortage is real, not theory, not speculation. It's built into the pricing itself. Now let's flip the lens. How does this look from the big players' side? The bullion banks, the market makers, the institutions short March silver contracts. They've got a real issue. Normally, in contango, they could just roll their shorts to April or May and pocket a small credit. But in backwardation, rolling costs them money. And if they try to deliver physical, good luck sourcing metal at $87 when Shanghai is paying $100. So what's left? You attack the paper market. You flood contracts into the low-volume overnight session. You push the spot price below $88, ideally under $85. You trigger retail stop losses. You shake out weak hands. You try to make physical delivery look scary, unattractive, volatile. And in my opinion, that's exactly what happened last night. This wasn't some routine profit-taking. It wasn't algorithmic selling or a technical breakdown. What we saw was a deliberate, targeted move to defend a critical price level. And I'll explain exactly why that level matters in just a minute. It's tied directly to this Friday's options expiration. But before we go there, you need to understand how backwardation works as a trap and why it's especially dangerous for the shorts. When the futures curve flips, it's not just a market quirk. It's a warning sign. It signals that paper silver and physical silver have split. The paper market says silver is worth 87 dollars. But in Shanghai, if you want the real thing, bars you can hold, it's trading above $100. These paper contracts are supposed to represent actual metal, but if that metal can't be delivered at the contract price, then what's the contract worth? It's a broken promise, a claim that no longer holds real value. And as more buyers catch on, as more traders demand physical settlement, the pressure on those short contracts starts to spike. They have two options: come up with the metal, which they likely don't have, or buy back their positions, potentially at much higher prices than they sold. That's a classic short squeeze. And backwardation is the first sign it's underway. It tells us supply is drying up, hoarding has begun, and the shorts are running out of exits. So when I see silver in 30-cent backwardation, I don't shrug it off. I see a loaded trap, and I'm just waiting to see when it snaps. Now let's break down the Shanghai arbitrage, because once you do the math, the situation becomes downright absurd. Imagine you're a big institution. You have access to COMEX. You've got physical inventory. You see silver trading at $87.59 in New York and $159 in Shanghai, a $13 spread. You buy a 1,000-ounce bar in the US for $87,000. You ship it to China. You sell it for $100,000. That's a $13,000 profit per bar. Yes, you've got costs, freight, insurance, export fees. Let's call it $2,000 all in. That still leaves $11,000 net per bar. Now imagine you're moving 100 bars. That's over $1 million. Pure arbitrage. No market risk. No directional exposure. Just buy low, sell high, collect the difference. So why isn't everyone doing it? Why does the price gap persist? Because the West doesn't have the metal. Vaults in New York, London, LBMA storage sites, they're either locking inventory, citing delivery delays, or making buyers wait months. By the time you actually receive your metal, the arbitrage may be gone. Meanwhile, in China, the premium holds, because buyers there don't care about contracts. They care about custody. They want the bars, not the paper. And as long as they're paying 100-plusers, while the West floats around 87s, that $13 spread acts like a vacuum, pulling every available ounce out of Western hands and into Eastern vaults. Which brings us to the key point. Last night's paper dump was no accident. The banks are trying to crush the paper price to make that arbitrage less appealing. If they can widen the logistics cost and time window enough, they can slow the flow. But ironically, all they're doing is handing China cheaper silver. They're accelerating the drawdown, because every ounce that moves east at $87 is gone for good, and Western inventories get lighter. The squeeze tightens. Quick recap. Because I've thrown a lot at you. Silver dropped 5% last night, down 461, but that drop came during illiquid hours on low volume. Meanwhile, physical silver in Shanghai is sitting $13 above New York's paper price. That spread should be closed by arbitrage, but it's not, which tells us there's no freely available metal in the West. And to make things worse, the futures curve is in backwardation. Spot is higher than future prices, which is a major warning that the market is screaming for immediate delivery. Those are the confirmed data points, chartable, observable. Now let's talk about the rumors, the unconfirmed theories circulating among insiders. I can't prove them, but they're worth knowing. Rumor number 1, the banks are trying to keep the SLV ETF under $80 through Friday's options expiration. Here's how it works. There's a huge stack of call options on SLV, the largest silver ETF, that expire this Friday. Many of those have an $80 strike. If SLV closes above 80, those calls go in the money. Market makers who sold those calls would have to hedge by buying millions of ounces of silver. That buying could cause what's called a gamma squeeze, where hedging itself drives prices up, triggering more hedging, creating a spiral. So the idea is, banks smashed futures last night to push SLV back down under 80 and avoid that squeeze. Can I confirm it? No. But the timing is odd. The $80 level is real. The open interest is heavy. There's smoke, even if we can't see the fire. Rumor number 2. Force majeure clauses are being prepped, or have already been triggered, at some major Western vaults. For context, A force majeure is a legal escape hatch. It allows a party to delay or cancel contractual obligations due to extraordinary circumstances, war, disaster, etc. The rumor is that some vault operators are considering invoking these clauses to delay physical silver deliveries, not because of war or floods, but because they simply don't have the metal to fulfill their obligations. Again, unverified. But in a market this tight, even the possibility of that kind of clause being used is enough to rattle serious players. Still unconfirmed, but if that headline breaks, if a major institution publicly announces a delivery delay due to force majeure, then the shortage moves from speculation to fact. It becomes real. Rumor number 3 is that several large silver miners in Mexico are deliberately holding back supply until prices hit $100. Mexico is one of the biggest silver producers on the planet. According to the theory, some of these miners have seen what's happening in Shanghai, they've seen the price divergence, and they're choosing to hold their metal, waiting for Western prices to catch up. I can't verify this, but if true, it would help explain why physical supply is tightening. The mines are still running, the metal is still being pulled out of the ground, it's just not hitting the open market. Now, I'm not sharing these rumors because I believe them all. I'm sharing them because they're out there. My job is to show you the full chessboard. Verified data sits on one side, unconfirmed theories on the other. It's up to you to decide which pieces fit based on what we can observe. Let's talk about the skeptics. There's always a counter-narrative, and it deserves to be addressed directly. Here's the skeptical case. Silver jumped from $80 to $92 in 2 days. That's a sharp $10 gain. A pullback of 5% isn't alarming. It's expected, normal, healthy. The claim is, this is just profit-taking after a strong rally. Nothing more, no conspiracy, just market digestion. Honestly, that argument makes sense, on the surface. Markets do breathe, bull runs pause. But here's why I believe this isn't that. First, the timing. Profit-taking doesn't usually happen in the dead of night. This sell-off came at 10:40 p.m., the quietest point in the trading day. A real profit taker would act during regular hours when liquidity is high, not when the book is thin. They'd offload positions slowly using algorithms to avoid slippage. They wouldn't dump 2,000 contracts all at once and get a worse fill. This wasn't portfolio rebalancing. This was a direct attempt to force the price lower. Second, no macro catalyst. If this move had been sparked by real news, a rate hike, a dollar surge, a big jobs report, we'd see it reflected in other markets. Gold would have dropped, copper too, the dollar would have rallied. But none of that happened. Gold barely moved, copper held up, the dollar didn't spike. So why did silver sell off alone in the middle of the night? The answer, it wasn't a market reaction. It was a price intervention. Third, the futures curve. In a real correction, we'd see the curve shift into steeper contango. The spot premium would fade, futures would trade higher, but instead, we still have backwardation. Spot silver remains above the March contract. That's not what happens when demand is cooling. That's what happens when buyers are urgently bidding for immediate delivery, not contracts 3 months out. Fourth, the Shanghai spread. If New York's drop were organic, the arbitrage window would close. Traders would sell in China, buy in the US, and bridge the gap. But the $13 difference isn't narrowing. It's stuck because the price in New York isn't real, it's paper. And in Shanghai, people are paying actual money to take physical possession. That's the real market speaking, and it's refusing to validate the Western price. There's one more piece I want to show you, and it destroys the normal pullback argument. Look at the volume from last night. The 2,000 contract sell-off came in one burst. Before that, volume was light. After, still light. That's not how broad corrections behave. If this were a wave of traders hitting exits, the volume would have been sustained, rolling over hours. Instead, we got a single, sharp spike and silence. That's not organic. That's surgical. Someone wanted the price down, and fast, likely before Asia woke up. So, no, I don't buy the healthy correction idea. The timeline is off. The volume doesn't line up. Fundamentals don't support it. And the Shanghai premium directly refutes it. This was a targeted move, plain and simple. Now let's talk about what comes next, because Friday is the showdown. The line in the sand. Why? Options expiration. Each month, futures and ETF options expire. And this month, there's massive open interest in silver calls, both in COMEX and SLV. A huge chunk of them are stacked right at the $80 strike, If SLV closes above $80 on Friday, those calls become in the money. The sellers of those calls, usually market makers, are now short gamma, which means they're forced to hedge by buying silver. And when they buy silver to hedge those calls, the price rises. That makes even more calls profitable, which triggers more hedging, and so on. It becomes a feedback loop, a gamma squeeze, a runaway rally triggered by mechanics, not sentiment. That's why this week matters so much. Someone is trying to keep the lid on. The question is, can they hold it until Friday's bell? That's what triggered the GameStop surge. That's what lit the volatility powder keg in 2021. And it could happen here in silver if the price manages to close above $80. So the institutions or whoever's on the hook for those short positions have every reason to suppress the price before Friday's bell. That, in my view, is what drove the sell-off last night. It had nothing to do with charts, news, or market cooling. It was about keeping price below a critical line to avoid a massive gamma feedback loop. And now we ask, do they have enough firepower to hold the line for another day and a half? Here's what I'm watching. First, the $80 level on SLV. If we climb back up and hold that number into Friday's close, I expect high volatility Monday. The hedging flows could be massive, and that may be the moment the dam finally breaks. Second, the Shanghai premium. If the $13 spread widens to $15, it tells us that Eastern demand is intensifying and Western vaults are being emptied even faster. At $15, arbitrage becomes irresistible. Logistics be damned. Third, the backwardation gap. We're sitting around 30 cents. If it jumps to 50, that's a clear sign the squeeze is escalating, and that trust in paper silver is breaking down. The wider that gap gets, the more irrelevant futures pricing becomes. Now, a lot of you have asked what I'm doing personally, so here's my plan. Not advice, just what I'm watching and how I'm approaching this. Trigger 1. If silver drops to $83, I'm adding to my physical stack. That's where we bounced last time on the way up. If it holds again, it confirms this drop was noise, not reversal. I'm not touching futures, I'm buying real bars. Because if the shortage is real, and I believe it is, the comics quote is going to stop mattering. What matters is whether you hold the metal or not. Trigger 2. If SLV closes above $80 on Friday, I'm sitting out the weekend, not buying into the squeeze. I'll wait to see Monday's open. If momentum is real, I'll consider re-entry on a pullback. If it fizzles, I wait longer, no chasing. Trigger 3. If backwardation hits 50, I'm ignoring the screen price altogether. At that point, the paper market is fantasy. I'll be watching delivery reports, vault data, and any signals of supply disruption or force majeure. That level of backwardation means the system is cracking. It's endgame territory. Also, here's what I'm not doing. I'm not panic selling. I'm not falling for the media spin that says this is just a blow-off top or a broken bubble. I've seen too many of these to be fooled by timing like this. The volume, the conditions, the execution, all of it screams manufactured move. So I'm holding tight, watching the signals, letting the market reveal its hand. Now, one last point I want to tackle, because I know it's on your mind. If the shortage is real, if the banks are this desperate, why not just let the price run? Why fight it? Simple. Because they're short. They've written contracts that obligate them to deliver silver or cover those positions at a loss. If price rockets to $100, $120, $150, those losses become catastrophic. We're talking multi-billion-dollar holes, so they resist. They hit the market during illiquid hours. They leak bearish headlines. They frame it all as a speculative bubble. They need to buy time, but the clock is ticking. Every day the Shanghai premium holds at $13. Every day backwardation remains. More silver leaves the West. More vaults empty, and the squeeze tightens. Eventually, they'll hit the wall. No more bars left to deliver. And when that moment comes, the paper price won't matter. The only number that counts will be what someone's willing to pay to physically take delivery. And I'll tell you now, it won't be $87. Now step back and look at this from the institution's perspective, the ones stuck in this trap. You're a bullion bank. You shorted silver futures at $90. You thought the rally was overcooked. You expected to collect the premium or roll the trade. But now silver's still near $88, and you've got a bigger problem, backwardation. To roll your position, you have to buy back the near month at a higher price than the next. That costs you. Every roll bleeds cash. And if you try to cover by delivering metal, good luck. You're either paying $100 in Shanghai or scrambling to find supply in London or New York. which may not even exist. So what's left? You force the price down, you dump contracts during the thinnest hours of the market. You try to make it look like there's panic, hoping to shake out buyers and reset the game. That's not a trade, that's a last-ditch effort to delay the reckoning. You hope the dump triggers stop losses. You hope it shakes out the retail crowd. You hope the price slips back to $85, maybe $83, ideally $80, where your short exposure starts to look manageable again. But here's the catch. It's not working. The physical buyers aren't playing by paper rules. They're still paying $100 in Shanghai. The backwardation hasn't eased, and every time you sell, every contract you dump, you're making it easier for real buyers to keep loading up. You're fueling the squeeze. You're tightening your own trap. This is what I mean when I say the math doesn't favor the shorts anymore. They're stuck in a loop. If they let the price run, their losses balloon. If they keep suppressing it, they only deepen the physical supply crunch. It's a no-win scenario. Their only hope is that demand collapses, that Eastern buyers suddenly stop paying $100 and start believing the $87 screen price. But that's not happening, and I don't think it will happen. Because Eastern buyers understand something many in the West still don't. This isn't about price. It's about possession. It's about locking in hard assets before the system breaks completely. Let me give you a final data point that ties it all together. I was reviewing ETF and vault flow data this morning. The SLV ETF, the biggest silver-backed fund in the world, has seen net outflows in recent weeks, not inflows, outflows. Investors are pulling shares and converting them into physical delivery. That's real metal leaving the vaults and entering private hands. Now, SLV's official statements say the inventory is there, and maybe it is, on paper. But if any of that metal is encumbered, leased, cross-collateralized, or otherwise spoken for, then the true available supply is far lower than reported. That's what keeps the shorts awake at night. The risk that too many investors ask for metal at the same time, and the vaults come up short. Once that happens, paper claims are worthless, IOUs backed by nothing, and that's why backwardation matters. It's the market's way of signaling, we don't trust future delivery, we want the metal now, and the longer that inversion holds, the more it confirms the shortage is real. Let's recap the hard facts. Silver dropped 5% last night, from above $90 to $87.59, on thin volume during low liquidity hours. That points to a coordinated price push, not natural selling. At the same time, physical silver in Shanghai is still trading over $100, a $13 premium. Arbitrage should close that gap, but it's not, which means no metal is available in the West to sell into it, and silver futures remain in backwardation, with spot prices 30 cents higher than March contracts, showing that buyers are bidding up near-term delivery and don't trust the out months. Finally, we have a massive options expiration this Friday, with a huge cluster of SLV calls at the $80 strike. If SLV closes above 80, the gamma effect could unleash explosive upward pressure. Those are the measurable signals. Now here's what I believe is happening underneath it all. The big banks are short silver, either directly or through derivatives. They're legally on the hook to deliver metal or cover those positions. And they're waking up to the fact that they don't have it. They're trying everything they can to keep silver below $80 to avoid a cascade of forced hedging. But they're out of time. The physical market has already moved on. The buyers in the East are still paying $100. The backwardation hasn't broken. Vaults are bleeding inventory. And no amount of nighttime paper dumping can reverse what's happening. The price you see on screen? That's noise. That's misdirection. It tells you silver's correcting. But the real market, the physical market, is telling a very different story. It's telling you the metal is scarce. It's telling you delivery is king. It's telling you the paper price is breaking from reality. So here's my short-term outlook. I expect high volatility. I expect the $80 level to be defended hard by the shorts. I expect more overnight dumps. But I also expect physical buyers to keep buying. I expect the Shanghai premium to hold, maybe expand. I expect backwardation to persist or widen. If we close above $80 Friday, Monday could be a blowout. If we close below it, the squeeze gets delayed, not canceled, because the underlying shortage hasn't changed. Here's my personal roadmap. $83 is my next buy zone for physical bars. That's the support I'm watching. If we retest and hold it, I'll be adding. Not futures, not ETFs. Metal in hand. If we close above $80 Friday, I'm sitting still over the weekend. I'm not chasing a gamma candle. I'll watch the open Monday and see if the rally has staying power. If backwardation hits 50 cents, I'm tuning out the screen completely. That's the moment paper pricing stops mattering. The only thing that counts is what someone's paying for immediate delivery, and that number will be way above $87. Now, a quick word on why I do this. I built this channel because I got tired of waiting half a day for mainstream coverage to catch up to what I was seeing in real time. And I got tired of AI-run channels pushing fake urgency and low-quality narratives just to game the algorithm. You're getting the feed here, directly. Live terminal data, vault flow intel, real-time reads, and my honest, unfiltered take on what it means. I'm a trader. I'm a stacker. I've been in these markets over a decade, and I've seen the playbook before. But right now, we're watching that playbook fall apart. The rules are changing, the arbitrage isn't working, the curve isn't correcting, and the paper market is getting called out. Hold the line, watch the metal, tune out the noise.